Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And we're just going to do another velocity banking review for today. You know what my favorite part of these demonstrations is that when you go from broke to rich in an instant without making more money. And if you've ever tried to introduce velocity banking to someone who like isn't aware of the concept, this is what I always do. Okay. I always just say this, hey, I don't even say the word velocity banking, okay? I just say, hey, if let's say you made really good money, right? $10,000 a month, and your expenses were about $10,000 a month, and you had let one penny left over in savings. Is it possible to pay off this debt relatively quickly without making more money, right? It's basically how you phrase it. And most people will say, like, hey, let's say I wanted to save 1,000, like, is saving money a good idea? They'll say, yeah, of course, like it's a good idea. And then, well, how are you going to save money here? And then this is kind of where their brain gets into a predicament because we're socialized by society that we need to save money, right? Saving money is the path to wealth. And what we're going to do is we're going to do velocity banking and not save money, right? So, what is velocity banking? All it is a debt payoff strategy where you don't save money. So, you see the savings column right here. And you're going to throw all of your money into debt into something called a line of credit. Okay. So, the first step of doing velocity banking is writing down all of your expenses, right? Or your debts. So you see the expense breakdown here, every single debt that you have here, because this is a debt elimination strategy. We're going to eliminate. And then at the end here, this is where all of our general expenses go: food, gas, insurance, all that other good stuff. Okay. And so the final step is that we're going to move some of our debt into a line of credit. And so, what's a line of credit? All it is a financial tool where you could borrow money, pay it back, and then use it over and over again. That's a line of credit. And then you put your entire paycheck into that line of credit and take your expenses out. Right. And so, what does a line of credit look like in real life? Well, this is my $280,000 line of credit. Yeah, $280,000. Okay. And basically, I can go to bank's website, click a button, and then they'll dump $280,000 into my checking account or up to with the 7.5% interest rate, right? And I have over $579,000 in lines of credit. In the future, I'll just possibly get more. We'll see. And yeah, so let's go ahead and assume we have a 75,000. No, not 75,000. Probably has to be $200,000 limit. Okay, and on our line of credit, and we can use it to spend anything. And this is my favorite part of velocity banking, because what we're going to do is we're going to transfer first these 10 credit cards into our line of credit, right? So 5, 8, 15, 27, 37, 10, 35, 35, 12, 18. And then we're going to do this. And this is $167,000 of credit card debt. So what we're going to do is we're going to move that $167,000 of credit card debt into a line of credit, and then I'm just going to put all of these as zero. So 0, 0, 0, 0, 0, 0, 0, 0, 0. And then now look at this. This is my favorite part. Let me go ahead and dramatically zoom in. How did we go from a penny to $5,345.84? Oh my goodness. How do we do that in an instant? Right? So now we're going we're going from I guess broke to rich. Is that how you say it? Broke to rich in an instant? And so now it's the final step, which is we put our entire $10,000 here into 167. Does two things: satisfies the minimum monthly payment, and then number two, it minimizes the interest because it's based on the average daily balance. And after every single month, this goes down, and then after every single month, it'll just go down. I'm sorry, go down by $5,345.84, which is our cash flow. And we're not going to save money. And I want to show you what this looks like in real life. In real life, it's not as exciting because really you're just staring at your bank account, and then we'll just watch it go zero, and whatever money comes in, it just goes into the line of credit, right? So let's go ahead and do this. And G2 plus H2 minus what's our cash flow? 5345.84. And then to calculate the balance, it's based on the average daily, right? So average daily, multiply it by the interest rate, and then divide by 12. And then this is going to be I2 plus 1, right? And then I'm going to copy and paste these, right? Copy and paste, right? And then we see that in 35 months, all this credit card debt was simply eliminated. It's gone, right? 35 months. All right. So now, okay, 35 months, 167K of credit card debt. And then now we tackle on other things like the auto, student, mortgage. Now we feel rich, even though we haven't saved money. And we literally did this in just one swoop if we had a line of credit. And I know some of you are out there thinking, how do I get a line of credit? And this is where you gotta honestly learn about the strategy before you even get to this situation, because it's kind of like you crash the car here and you're trying to get car insurance. That's like your line of credit. It's kind of like your car insurance after you crash the car. And so what you want to do is you want to get the car insurance before you crash the car. So what I mean by that is that banks don't lend money to people who need it. They don't, right? So if you're in the situation where you got one penny left over, they're not going to give you a line of credit for the most part. So that's why you have to get the lines of credit before you ever need it. And then you probably won't even get here, right? As long as you know the strategy. So this whole situation is like, hey, this is a warning of not to get here, right? Not to get here. All right, so let's go ahead and do this. And we get to our loan calculator at 35 months. And let's do this. And I'm going to copy and paste. And 35, 35, 35, 35, 35. Now let's get rid of this auto loan. We're going to move this $8,000 into the line of credit. And a lot of people, this is what they do. They focus solely on the interest rate, right? And I think that's why they don't really pay off debt that quickly, because what they do is probably throw all their hard-earned cash into here and then eventually give up, because throwing all your money into a loan is actually a smart thing, but it's hard for most people. It actually is. And why is this? Because a loan is a one-way street. It's a one-way street. Okay. And so what we're going to do is that, yes, we're going to have lines of credit where we might move some debts that are a lower interest rate into a higher interest rate. But as long as we have the cash flow, it ain't no big deal. Right. And this is what we're going to focus on. So if you want to know why we move this auto loan into the line of credit, it's because it gives us the most cash flow for paying off this debt at this current moment. Right. So I pay 8 grand, I get 360 in my cash flow. 11 grand, 144, 34 grand, 499. So according to this cash flow index, which is like a ranking system, this is the lower the number, the more bang I get for my buck. Okay, so let's go ahead and do this and Control V and plus 8820.93. And now this is going to go to 0. And then now our cash flow is $5,700, right? It's $5,700. So let's go ahead and do this right here. And let me go ahead and read that. So this is going to be now 5714.17. And then we see here, Quiblamo, just 2 more months till the auto loan is paid off. So 37 months. And then this is going to be 187K. And then this is where the fun begins. Remember that from Star Wars Revenge of the Sith? All right, so 37 months. So this is 0. And then this is 37, 37, 37, 37. And then we're going to focus on this one because this one gives us the most cash flow for paying off the debt. So let's go ahead and focus here. So it's not necessarily the snowball method, because snowball method would dictate go here and then go here, right? Which would work. I mean, it's not going to make that big of a difference, but let's focus on that cash flow. So what are we going to do here? Well, we're going to do something called the chunking method. So for example, we're going to move about 10 grand of this loan into the line of credit. 10 grand. Okay. And so let's just do this right here. I'm going to move $10,000 plus 10000. And then you see that in 2 months it got paid off, right? 2 months it got paid off. And then we just rinse and repeat over and over again. So about 6 months, I think we should pay off this loan. And luckily we have a velocity banking calculator to help us figure this all out. And so give me one moment here. All I got to do is just fill in the income. And what's my income right now? It's an insane 10,188.62. All right. So 18188.62. And then this is what I'm going to do is I'm going to calculate the expenses. So it's everything except for the loan we're trying to pay off. So let me just do this. Okay. And then this is 0. And then I'm just going to do this. And then so this is $3,974.86. So 3974.86. So, right, 3974.86. And then we'll just do an $11,000 chunk. Okay. And so now let's just go here, right? And then what's the current? Okay. 45 at 6%, 45,000 at 6% for 10 years. And what's the payment amount? It is 499.59. 499.59. And then what's the current balance? It is 33870.01. 33870.01. All right, so half a year, right? 6 months. I was right. 6 months. All right, so let's go ahead and do this. So this is going to be 37 plus 6, 42. All right. Oopsie, not this one. It's actually this one. 42 months, and then now it's 187 plus 45, which is 232,000. Okay, 232,000. This is 0. And so now, okay, so our cash flow is $6,213.76. Okay, so now let's just go with the next one, which is going to be, so this is now 0, and then this is now 42, 40, is it 42? 43. It should be 43, right? Because it's 37 plus 6 months, which is 43 or whatever. All right, 43 months, I believe it is. Yeah, 6 months. Okay, so 43, 43, 43, 43. All right, so now I'm going to move this. Should we move this entire 13 grand into the line of credit? It doesn't matter. I mean, it's, yeah, let's just do it because it's so close to what we have. I mean, to our income. So I think we can move it into the line of credit. So let's go ahead and do this, copy and paste this. And then I'm going to do this plus 13731.49. Okay. And then I'm going to highlight this. All right. And then this is going to be 0, right? So an extra $200 in our cash flow. And then I'm going to go right here. Okay. So 6416.25. All right. So now all right. We got this paid off in 2 more months. So wait a minute, I screwed up. Yeah, I kind of did because well, it's just going to be 2 more months, so I'll just put it that. So 45 months. Or maybe I should just use that velocity banking calculator. Oh well. All right, so this is going to be 452K, and then I have 45 months. What's the balance here? So this is 0, and then this is 0. And then now we're going to move that 9,000 into the line of credit. Actually, let me just use the velocity banking calculator because you're not going to really chunk more than This one you could actually just move the entire thing into the line of credit, I believe. But let's go ahead and then move it. I'll just do this. Maybe a little bit lazy. So 15 grand, 15000, 3%. And then what's the current balance? It is 9894.21, 9894.21, 144.84. And then this is going to be 9894.21 for moving the whole thing into a line of credit. And then we see 0.1 years. So 0.1, what's 0.1? I don't even know. 0.1 times 12. We'll say 2 months. All right, so that's going to be 47 months. And then, all right, so this is now 0. And then this is going to be 252 plus 15. So it's 267K. Okay, now it's time for the mortgage. So at 47 months, what's the balance of the mortgage? So 47, 0. And, I know a lot of people, they look at this and they kind of cringe because it's like, who makes $10,000 of income a month? And what's funny is that somebody wrote that like in a video I had a long time ago. And then there was another person who commented, it was like, oh, I work at a hospital, I make 10 grand a month. What's the big deal? Right. And then someone else wrote, like, oh, I make 20 grand a month. And I was like, I just think it's funny. You know what I mean? Like, um, people put their own, I don't want to say biases, but what they do is that they look at mass media and then they think, oh, well, it should apply to me, even though mass media applies to the masses. You know what I mean? And so, like, I don't know why people think that when they look at mass media, they think that, it's gonna supposedly apply to the situation rather than trying to understand the concept, right? But I've literally had people who go like into my channel and go like, "Oh, well, 10 grand a month. No, nobody makes that." And I'm like, "All right, well, like I take a look at this." And then other people like write like, "Oh, that's no big deal." But although it's kind of like, you kind of have to be aware of what the averages are. So again, this velocity banking thing is not a debt payoff strategy. Or I'm sorry, it is a debt payoff strategy. It's not an income generation strategy, right? That's something that I feel like a lot of YouTubers have to differentiate, and understanding why a bank would give you a loan because they don't want you to pay it off too quickly, and their favorite customer is someone who makes a lot of money but is just kind of bad at managing it, right? Kind of bad. All right, so let's go ahead and do this. And yeah, last one. I just got to type it in. See how easy this is? You know why I love this strategy? Because I really don't have to think. I just plug in numbers, and then that's pretty much it. Like, I don't know what I- I'll be honest. I've been doing this for like over a year now, just YouTube video after YouTube video, and it's kind of like I've brainwashed myself so bad that if I don't pay off a mortgage in like 4 years, I feel like something is wrong. And you know what's crazy is that some YouTubers teach this and they're like, well, if you put your low interest rate loan into a higher interest rate line of credit, you could pay off your loan in 16 years or your mortgage in 16 years. And I'm like, that's insane. It kind of depresses me. Maybe just a little bit. All right, so let's go ahead and do this. So 220,000, and then what's the current balance is 201,196.54. All right, and then this is going to be 2.9 years till we pay off the mortgage. 2.9 years, so it's 45 divided by 12 plus 2.9, and then it's going to be 6.65 years, and then we are debt free. Woohoo! Look how easy that was. And so that's going to be what's that? 252 plus 220, 472K. That was easy. So yeah, now we're rich in an instant, right? Now obviously you need to make the income, but again, velocity banking is a debt payoff strategy. I never said it's an income generation strategy. And you only get debt when you have income because banks don't lend money to people who need it. And then they want you to eventually get to a point where you do need money, and then that's when they'll stop lending to you because you're too high of a risk, right? So, yeah, that's it for today, folks. This is Korean Atlanta Mentorship, just another velocity banking review. Oh boy, am I sleepy. Am I sleepy? All right. Well, that's it. And I'll see you on the next video.